Every successful journey begins with direction. At Axis Wealth Management, we are the compass for your financial future, helping leaders, executives, and legacy builders plan, grow, and preserve their wealth with confidence. Through expert financial planning, tailored investment strategies, and offshore investment opportunities, we give your money the direction and structure it needs to work harder and last longer. Our bespoke investment solutions are crafted with precision and built around your unique financial goals. Backed by deep market insight and a client-first approach, we help protect what you have built while positioning you for future growth. Because real wealth is not built just for today, it is about building a legacy for tomorrow. Speak to our wealth advisors on 02630-15323 to learn more. Axis Wealth is licensed and regulated by the Securities and Exchange Commission. Axis Wealth Management, your trusted partner in building sustainable wealth.
You're warmly welcome to the 2026 Mid-Year Economic and Market Outlook webinar. This is the fourth edition of the event, and we are excited to have you join us for what promises to be an insightful and impactful session that will position us for the investment success in the second half of the year. My name is Mildred Sophia Atto, and I will be your hostess for this morning's session. Joining me today are speakers from the Wealth Management team who will provide an overview of the wealth management offering, share a comprehensive economic and market analysis, and deliver projections for the year ahead. To do this, I am joined by seasoned experts from the Wealth Management team in the person of Peter Bewa, Albert Boateng, and Eric Quartey. Each speaker will have an allotted time to present, after which the remaining time will be dedicated to answering your questions. Should you have any questions during the session, kindly submit them using the Q&A tab and it will be addressed. At this point, it's important to mention that the information shared at this webinar is for educational purposes only and does not constitute investment or financial or tax advice. Participants should seek independent professional advice before making any investment decision. Axis Wealth accepts no liability for actions taken based on this information. And so, without wasting any more time, I will hand you over to Albert Boateng to share some details of the Axis Wealth operations.
Thank you. Thank you so much, Mildred. Thank you for that introduction and good morning to our cherished participants. And once again, you are welcome to this morning's webinar. We thank you for spending a bit of your morning with us. And in the next few minutes, I'll briefly take you through who we are at Axis Wealth and what sets us apart as far as our offering is concerned. And so at Axis Wealth Management, we are a personal financial and wealth management firm licensed and regulated by SEC. That is the Securities and Exchange Commission here in Ghana. Though we are independent in terms of as an entity, we are a subsidiary of APG Holdings, the mother company of Axis Pension Trust, which administers more than 10 billion cedis in client assets. And for Axis Wealth, our business is simple: to help individuals and families comfortably grow and preserve, as well as transfer wealth to the next generation. And to achieve this, we leverage sound financial planning and global investment opportunities, helping our clients make better financial decisions and ultimately achieve sustainable transgenerational wealth. So now moving on to points of differentiation for Axis Wealth. Now that we know about Axis Wealth, why do we recommend you work with us? At Axis Wealth, we believe each investor is unique and therefore deserves a unique wealth plan or strategy. For this reason, our wealth advisory is rooted in comprehensive financial planning. We take the time to understand the client's unique situation, your financial goals, your current resources, liabilities, your risk profile, that is your willingness to take risk as well as your capacity to take risk. Then your horizon as well, how much time you have to hold the investment. And armed with all of this information, we then develop a wealth strategy specifically for you. So it's not a one size fits all or a cookie cutter approach. The solutions that we recommend or that we offer are tailored to your unique or the client's unique context. And another point of differentiation or another differentiator is our independence. So at Access Wealth, we do not have any commission-based arrangements with any investment or financial house or product sponsor. We operate by simply recommending quality investment positions or opportunities offered by some of the top financial houses in the world, such as BlackRock, Invesco, JP Morgan, Vanguard, and these opportunities that we recommend to clients or we build portfolios with are selected after conducting thorough research and also based on the needs of the specific client that we are dealing with. And so this independent approach gives us, greater flexibility to construct diversified portfolios using a wide range of global investment instruments. And we believe that wealth management is fundamentally a people business. And when it comes to people, I dare say Axis Wealth can boast of some of the most passionate and ethical professionals we have in the industry. Our team brings together professionals across wealth advisory, estate planning, compliance, real estate advisory, and the works. I mean, name it, and would get, if we don't have an in-house resource, will recommend a well-vetted resource to assist our clients achieve their goals. And our role is not simply to help you invest. I mean, that's important, but it's not just that. We are there to provide that professional guidance needed to navigate important financial decisions when they come up. And when we are considering where to invest, I believe one of the most important questions, and we come across this question a lot when we are engaging with the market. And the question is, how is my money protected? So our clients are afforded several layers of safeguards to ensure robust investor protection. Your wealth is protected through rigorous risk management, secure processes, and strict adherence to regulatory standards and compliance. Every entity in the value chain on the service we provide is licensed and regulated. The wealth advisors, Axis Wealth as an entity, and our partners in the offshore markets are all licensed and regulated by the relevant bodies. And let me add that each wealth account we open has a complimentary insurance cover of up to $30.5 million, ensuring that you have peace of mind while you invest. And so, like I mentioned, there are several layers of safeguards for our clients. Then another important consideration here, and a lot of times you present or you speak to clients and they'll say, you know what's the bottom line? And I know cost of investing is a key factor investors consider when investing, and our fee structure is designed to be transparent and aligned with our clients' interests. We do not have any hidden entry fees or exit fees that we see with other firms in our market. And we charge a fee of 1.5% of assets under advisory. And as mentioned, this approach is intended to create greater alignment between our success and our clients' success as well. And so your growth, your wealth preservation, and the transfer of wealth is our sole priority, and that's what guides us as our North Star. And finally, our relationship with our clients does not end once the investment is done. This is not a touch and go service, right? We believe that wealth management should be a long-term partnership because markets will rise and fall. Your financial goals may evolve over time. Your situation or your circumstances may change. And so we need to ensure regular communication to ensure that all parties are on the same page. And so our ultimate goal is to become your trusted financial partner in building sustainable wealth. So, what is the next step? If you are interested in exploring how professional wealth management or global investment opportunities, offshore investments could fit into your financial plan, we invite you to book an appointment for a one-on-one conversation with us. Simply send an email to info@accesswealthmanagement.com. The email is on your screen, and once you do that, we'll schedule a free consultation with you, and we'll take it from there in terms of the conversations. And so at this point, I want to say thank you for your time and for your attention, and I'll hand over to Eric for the next section of the presentation.
Thank you very much, Albert, and thank you very much, our wonderful audience. It's always a pleasure to have you on our platforms. This section focuses on the global economy and markets, so let's dig in. So we start with the big picture. The major takeaway is that the disinflation trend that has been in place since early 2024 and parts of 2020 and 25 broke this year. 2025 broke this year. A conflict in the Middle East disrupted energy markets starting the first quarter, and that shock is still working its way through the global economy. The good news is that growth has been more resilient than many feared. Global growth is now projected at 3% for 2026, down only modestly from 3.5% in 2025, largely because AI-driven technology investment and demand has offset a lot of the drag from higher energy prices. We are seeing a genuine two-speed world. Now, this is what's happening. Economies plugged into the AI technology value chain are outperforming, while energy importing economies outside this chain are feeling more strained. On monetary policy, the Fed under new Chair Kevin Walsh has been fairly hawkish and held rates steady at 3.5 to 3.75% all year. And in June, the European Commercial Bank actually reversed course and hiked the rate for the first time since 2023, taking its deposit rate to 2.25%. As far as markets are concerned, after a rough first quarter due to major sell-offs and the instability in the Middle East due to the US-Iran war, markets staged one of the most remarkable rebounds we've ever seen in the second quarter. So looking forward, we still see a lot more volatility ahead. My senior colleague Peter will unpack this further in the course of the webinar. So turning to inflation, global inflation has fallen steadily from a peak of 8.7% in 2022 down to 4.1% in last year. 2026 breaks that pattern as we see inflation inch up in 2026. Now, the IMF expects global inflation to accelerate to 4.7% this year, driven mainly by higher energy and food prices tied to the conflict. Last month, look at the line chart underneath. Both the US and Euro area we're on a gentle downward glide path through late 2025 into January 2026. US inflation actually bottomed around 2.4% in December 2025. Then you can see the sharp turn. Both lines climbed through February to May as the energy shock fed through before easing again in June as a ceasefire brought energy prices back down. The US posted 3.5% in June, down from a 4.2% peak in May. The euro area also posted 2.8% down from 3.2%. Emerging markets picture is similar in direction. The IMF sees emerging market inflation rising to 5.8% in 2026 from 5.2% in 2025, with oil importing emerging market economies feeling the pinch more on the food and fuel prices side of things. So let's see how the central banks have reacted to some of these inflationary pressures and inflationary issues. So from a monetary policy point of view, now we want to understand how central banks responded to inflation. The Fed has been the most disciplined, and we have to give it to them. It's held the funds rate steady at 3.5% to 3.75% through every single meeting this year. Now, the new chair, Kevin Walsh, he took over somewhere in June this year and he has been notably hawkish in tone than market has expected, flagging that a hike, not a cut, could be the next move of inflation if inflation doesn't continue to cool down. Now, the ECB, the European Central Bank, actually moved after cutting rates steadily from 4% to 2% between mid-2024 and mid-2025. The Governing Council reversed course in June and hiked 25 basis points up from 2 to 2.25%. This is the first hike in nearly 3 years, explicitly citing inflation pressure mainly due to the conflict. And you can see emerging market policy rates are following a similar trajectory to the 2022 tightening episode. So back up as oil importing economies act to defend their currencies, and inflation expectations has also been anchored, even as the general direction over the last few years have had been toward easing, having some bit of easing within the system. So let's talk about growth. Turning to growth itself, the US posted 2.1% annually growth in the first quarter of 2026. That's a solid number driven by business investments, even though the US is a consumer-led economy, is still an impressive number for such a big economy. This follows a choppy 2025, and you can see the quarter-by-quarter path on the bar chart. From a slight contraction in quarter 1 2025 through a strong 4.4% performance in Q3. Europe is where the energy shocks shows up directly. The euro area contracted 0.2% quarter on quarter. In quarter 1 2026, its weakest quarter since 2023, as higher energy costs and softer external demand weighed in on activity. So what is emerging markets also looking like? Emerging markets are still growing faster than the developed markets. But the IMF sees that growth is likely to slow to 3.8% in 2006, down from the 4.5% we saw in 2025, reflecting the same uneven exposure to the war and technology cycle we talked about at the beginning of the webinar. The economics plugged into the AI-related exports are having a good time, better than those who are not plugged into the whole AI phenomenon. Now, how is markets reacting to all this? And your markets will always paint a picture of your macros, right? So this is where the macro story shows up more vividly. We look at Q1, look at the Q1 2025 row. Nearly every index is in negatives, with the EU area down over 10% as the initial energy shock and conflict headlines hit risk appetite. Then look at Q2 2025 and Q3 2025. A strong broad-based recovery as markets adjusted. Now jump to Q1 2026, you see the same pattern. renewed weakness as the conflict escalated again, with the S&P down 4.3% and the EU area down 10% for the quarter. And then Q2 2026, one of the strongest quarters on record. The S&P turned over 21%, the Russell 2000 over 21%, and emerging markets over 24% as a ceasefire eased risk premium and AI-driven earnings strength broadened out, across the largest technology names and even into small caps and even emerging markets as well. For the full year 2025, every index finished solidly positive, led by emerging markets at nearly 34% and the EU area at 20%. A reminder that outside the US, both Europe and emerging markets had a very, very strong year. Now, before I hand over to Peter, we want to talk a bit about what happened in the fixed income markets. So fixed income markets, basically it also tells a complementary story, nothing different from what I've spoken about so far. Now, the US duration treasuries and then investment grade high yield was also fairly choppy through the first half, with a weak first quarter of 2026 for obvious reasons, and yields rose on renewed inflation risk, followed by a much better second quarter at the ceasefire calm market. US high yield returned 2.5%, and the 10-year plus paper stabilized. We saw that the 10-year paper stabilized within the quarter, getting to the end of Q2. The standout story, however, is that emerging markets and frontier debts, shown here under Africa, excluding South Africa, after a rough first quarter, frontier and African Eurobonds staged a sharp rebound in Q2, up nearly 6%. As the European of the Eurobond window, the Eurobond window gave room for sovereigns like Kenya, Cote d'Ivoire, and others to return to the international capital markets, after sentiments had more or less improved. For the full year 2025, investment grade credit returned over 10% and high yield over 9%, both benefiting from the Fed's late 2025 cut. A reminder of just how much the policy backdrop has shifted in the last 6 months. At this point, I will hand over to my colleague, Mr. Peter Bewa, to take us through the rest of the presentation. Thank you.
Thank you very much, Eric. And once again, thanks you to all of our audience for making time to join this webinar. It's always a pleasure to come to you to share our thoughts on the markets. So I'll dive right in. So before we get into the actual outlook for the rest of the year, we're going to do a quick snapshot of where we are currently and how the markets have performed or behaved over the last 6 months. So just to piggyback on some of the points that Eric made, we are currently experiencing a very stable economic growth, using the US markets as a barometer, which is the largest markets or largest economy in the world. And when the US catches a cold or sneezes, the rest of the world catches a cold. And so we'll use that as a barometer. But the US is continuing to enjoy stable economic growth. GDP grew at 2.1% in the first quarter. And the second quarter numbers are going to be coming out this week, but markets expect that level of growth to pertain. And so we expect GDP to continue to be around 2%, which for a large economy, that's pretty strong. We've seen inflation trending higher, away from what the Fed's preferred target is. The Fed's target has been 2%, which was kind of trending around getting close to that target since the peak during post-COVID era when we touched higher than 9%. It trended down to over 4%, came back down to below 3% as of end of last year. Beginning of the year, it started trending higher, simply primarily due to the war in Iran, and most of it was energy driven. And so we saw inflation go as high as 4.2% 2 months ago. Last month, it's come back down to around 3.5, but we think that inflation is likely to continue to trend, higher than the Fed's expectations due to the impact of the crisis in the Middle East. Energy is kind of systemic throughout the economy, and so when energy prices are high, that affects most other sectors in the economy. We continue to see stable unemployment levels in the US market. So we saw unemployment continue to hover around 4.1, 4.2%. We've never had any recession in the past with unemployment less than 5%. And so we have a lot of room to go as far as employment goes. And so with unemployment around 4.2, the economy is almost, at full employment at this point. And so that's also a very positive number. Consumer spending continues to be very, very stable. So closely linked to unemployment level is consumer spending. When consumers have jobs, they tend to spend. What we've seen that due to inflation, there's been changes in the pattern of consumption, where discretionary spending is kind of reduced a little bit, but people are still spending. As long as they have jobs, they'll continue to spend. The US consumer makes up about almost 70% of the GDP. And so there's a huge chunk of the components of the GDP. So as long as consumers continue to spend, we expect the economy to continue to hum along. The other big catalyst has been strong corporate earnings, and so companies continue to record profits. Q1 saw huge beat rates as far as estimates versus what actually companies experienced. Q2 so far earnings have been very, very strong as well. So far, amongst the S&P 500 companies, the numbers that the companies that have reported, we've seen over 80% of them beating their estimates. And we think that that trend is going to continue, with the rest of the earnings season. And with all that being said, we've seen the markets perform very, very strongly. So equity markets have been strong this year so far. All the indices are positive for the year. The biggest standout has been the small cap with Russell 2000, performing close to 20% and beating out of indices and other benchmarks. And so we've had a very strong market performance this year. And we think that that trend is going to continue for the rest of the year. Although we're going to see a lot of volatility due to some of the uncertainties, on the macro front. So with all that being said, the sectors that have actually outperformed so far year to date are energy, industrials, and infotech. So energy was a bit of a surprise. It wasn't expected at the beginning of the year, but that was mainly driven by the conflict in Iran. So with the Strait of Hormuz being closed for a while, energy prices have shot up, and that has made energy companies being able to, jack up prices and benefited from that situation. But we don't think that trend is a long-term play. Because as soon as there's a resolution to the conflict, the energy prices are likely to go back to what persisted prior to the conflict. So we think that is a tactical play for a lot of investors, but it's not going to be a long-term one. But with all that that has happened, energy has outperformed so far year to date. And the next sector that has really done well is industrials, and that's primarily due to the whole reshoring and industrialization going on in other parts of the world, as well as the data centers being built across the globe to support this whole AI phenomenon. And then, excuse me, with the tech space continuing to dominate as far as this whole AI phenomenon, with chip manufacturers and the other supporting software and other sectors that are closely allied, is made, tech continues to be one of the best performing sectors. So those are the three sectors that have outperformed so far year to date. Sectors that have underperformed include consumer discretionary. Like I said earlier, even though consumers continue to be strong, due to high inflation and high energy prices, spending patterns have kind of shifted. And so the space in general, consumer discretionary space in general has not done really well, although there are pockets or subsectors within the space that have done well. But when you look at discretionary, places such as, housing, for instance, has not done very well. Luxury goods haven't done very well, and a few other areas. And so the broad sector has not performed well, even though consumers are still in a strong position. Also, communication services hasn't done well, and then financials as well. The other sectors that are not mentioned here have kind of performed close to the markets. And so that's what we've experienced so far year to date. So with all that, what is our expectations for the rest of the year? So for the next 6 months, we still expect that inflation is likely to remain high. So inflation expectations are higher for longer. We don't think that we're going to go close to the 2% target that the Fed, anticipates anytime soon. And that's primarily due to where we are with energy prices. And as far as the conflict in the Middle East, it's resolved, or there seems to be some resolution one day. The following day, there's counterattacks and counter accusations, and right back to square one. And so we don't see a long-term resolution anytime soon. And so we're gonna have to, deal with the volatility that is going to come from that area for a while, and that's likely to lead inflation to stay a little higher than expected. So that's what our expectations are. As far as employment, we still expect that the employment numbers are going to be stable. Job growth has not really been very, very strong. However, the layoffs has also been very, very minimal, and so there is a stable, job environment. When the Trump administration first got into office last year, they did, what they called the trimming down the federal government through the whole Doge phenomenon. But that has, kind of tapered down a little bit. They've actually recalled a lot of people that lost their jobs. But what that has done is it's, made a lot of federal employees not have a lot of confidence in their, job situations. Even though they are still employed, they are not very, very comfortable with the future of their jobs because they could lose their jobs anytime. And so that makes people want to save instead of spend. And so that's one of the reasons why, we're not seeing discretionary spending doing too well. But the employment situation continues to be stable. And so we're not seeing a lot of layoffs like we saw at the beginning of the administration's, term. But we've seen a lot of investments from private, sector, a lot of commitments to build, factories and data centers all across the US. And so that is also providing, continues to provide jobs. And that's going to bode well for the rest of the year. Closely linked to the inflation is the rate expectations. And so beginning of the year, we were anticipating the Fed was likely to cut, rates at least once, if not twice, before the end of the year. That has completely changed as of this point due to where inflation is. So we do now expect that the next Fed move is likely to be a rate hike in order to, bring down inflation. We may not have any moves this year, but if there's going to be any move at all, it's likely to be a hike because the new Fed chair appears to be more hawkish than the markets anticipated, and so rates may likely go up if inflation continues to go in the wrong direction. So that's something to expect the rest of the year. However, the economy will continue to, be stable. We think that economic growth is going to continue with where we are as of now, with GDP around 2%. That's very, very positive for such a strong or a large economy. And that means that we don't expect any recession on the horizon anytime soon. The technical definition for recession is two consecutive negative quarters. And if the economy is growing above 2%, that's nowhere near a negative, quarter anytime soon. And so that implies that there's still opportunities to invest in the US as well as other, markets around the world. And that portends or brings a lot of opportunities for investors. So those are the positives, or those are the main, macro data points. However, the risks that we continue to see are the trade and tariff uncertainties. And so coming into the beginning of the year, we highlighted that the biggest risk we see on the markets is the uncertainties for the Trump administration. That continues to be an issue. Even though the Supreme Court annulled most of the tariffs that were passed last year, Trump has just released a new round of tariffs just this past weekend on almost all of their trading partners, the US's trading partners. And so those will likely also be challenged. And a lot of the trading partners will likely retaliate with their own tariffs as well. And eventually we might get some kind of resolution. But while that is all playing out, it's going to lead to volatility in the markets. And if fundamentals for a lot of the companies that we invest in have not changed, these pullbacks, represent buying opportunities that we'll take advantage of. But we need to be aware of some of these risks. So the trade and tariff uncertainties still are in play. And then the other risk is geopolitical tensions. And so we started the year with the Russia-Ukraine war coming into the fourth year. So that has been playing in the background. We had the whole Israel and Hamas situation also still going on. Nobody expected a new war to start with Iran. But that has, that is now getting into its in the fourth month. It was supposed to be a very, very short in and out situation, but it's going longer than the administration anticipated. And so geopolitical tensions continue to persist, and that's something that we cannot do away with. We just need to be aware of it and manage our portfolios with that at the back of our minds. And so those are the two main risks that continue to affect our investing decisions going forward. So what all this means is that there's still opportunities to invest across the globe. So I'll go region by region, starting with the US markets, being, the largest economy in the world and where most of our investment opportunities come from. There's still opportunities to invest in the US due to the fact that they have a stable economic growth. For the largest economy to continue to grow above 2%, there's a lot of opportunities there that we want to take advantage of. So we still like the US market, although we reduced our allocation due to valuation concerns beginning of the year. That's still the bulk of where we see the investment opportunities are. Like I said earlier on, we're likely to have inflation continue to be high for longer. But with inflation, being high, it portends well for equity investments. So equities are the best hedge against inflation long term compared to fixed income, because a lot of companies are able to pass on the higher cost, to consumers. And so that makes, having inflation continue to be high makes investing in equities very, very, very attractive. We also continue to see solid corporate earnings from these US companies that are reported. The beat rate, like I said, is over 80%, and we think that trend is going to continue. And so that also makes investing in the US very, very attractive. The biggest concern on the US market is valuation issues. So a lot of companies have had their valuations kind of stretched. And that's why lately we've been seeing a lot of volatility, especially in the tech space. And so when companies that are, trading way higher than their fair value estimates, pull back, we see those as buying opportunities. A lot of the times when there's a lot of volatility, those are the companies that have actually pulled back. So lately, we've been seeing over the last 2 to 3 weeks, we've been seeing a lot of tech names, pulling back, 5%, 4%, 6%, and stuff like that on a single day. So that's primarily due to the fact that some of these companies are overvalued. And so that's something to keep an eye on. So even though the US continues to be a favored investing destination, not every sector is likely to do well in this environment due to valuation concerns. And that's why active investing and active management comes in very, very handy. And so it's not going to be a rising tide lifting all boats. We have to be selective as to where we actually deploy capital. And that's what we do here at Axis, looking for the right opportunities and the right companies. Moving on to Developed International. The opportunities in Developed International is stemming from increased infrastructure and defense spending. And so one of the things that the Trump administration did was to cut back on supporting a lot of their partners in Europe on the defense side. And so that has, made a lot of the other economies stepped up as far as their spending. And then they've also increased investing in infrastructure to bring, some of their factories and industries back to their economies. And that's a way of diversifying away from China post, COVID. The other, but however, the risks or the issues with Developed International is that their populations are aging, and so there's not a whole lot of consumer spending projected on the long term. So even though there's a lot of investments on the industrial side and the defense spending, the consumer side is not very, very strong. And then the economies are slowing. So the opportunities in that part of the world is limited compared to United States and also emerging markets. Now, emerging markets is that's where we see the most long-term opportunities at this point. And so we actually increased our allocation to emerging markets. But the opportunities in the emerging markets are stemming from reshoring and industrialization. And so post COVID, a lot of economies have been working to diversify away from China because of supply chain constraints that were experienced during the COVID when China locked down a lot of the supply chain systems. So economies are diversifying away from China in order to be self-sufficient, and then large companies across the globe, such as Apple, other big companies in the US, have also invested in factories outside of China, and so countries like India, Mexico, Brazil, Vietnam, Taiwan, are all benefiting from what had been the trend in the past 30 to 40 years, with everything coming out of China to now, having a diversified source of supplies. And so we've seen a lot of investments going to other parts of emerging markets, and that also provides a lot of investment opportunities. The other plus for emerging markets, why we like that space, is that they have favorable demographics. And so the youngest populations currently in the world are in emerging markets. And so that provides, consumer spending on a very long term basis, where we have, more family formations, coming up on the long term, which also going to provide a lot of spending, that's going to benefit industries and companies that will cater to some of these needs going forward. Emerging markets also have very, very attractive valuations compared to overvalued markets like the US. And so you have companies that are doing really well, that have a long growth, trajectory, but selling for lower PEs compared to matured companies in the US. However, the biggest risk in investing in emerging markets is that region continues to be the biggest brand of some of the Trump trade and tariff, policies. And so that's something to be aware of when we're investing in emerging markets. So looking forward, the sectors that we want to be overweight to are industrials, primarily due to, like I said, the reshoring and industrialization going on around the globe. Um, Also, its industrials continue to be the third iteration to in this whole AI phenomenon. And so data centers being built across the globe to support the AI play continue to attract a lot of investments, and that makes industrials very attractive. We continue to like infotech. So within that space, we like the chip manufacturers. We like the equipment makers that supply the chip manufacturers. We like the software companies, and we like the hardware companies as a broad category as well. Technology continues to permeate every other industry. And so the trend and the tech space is going to continue in the long term. That makes it very attractive. We like consumer communication services as well, which was very, very closely aligned with the tech space, and that's primarily due to increased, ad spending in that space. So we've seen, a lot of companies shifting from spending on the traditional media to spending online, and that makes, communication services another attractive space or sector that we like. And then utilities is the other sector that we like very much. So there's not enough energy to support this whole AI phenomenon. And long term, there's a lot of investment going into nuclear energy um, in order to, supplement the other sources of energy that are already existing. And there's a lot of clean investments to clean energy as well to support this whole the data centers that are being built, and as well as the whole AI phenomenon. And so we like technology, we like utilities very, very much long term. And then we think that that's a long term play that, we're going to see investing dollars flow into. Sectors that will be underweight to going forward will be energy. Like I said earlier on, the energy outperformance year to date was primarily driven by the war in Iran. And we think that when we see a resolution, energy prices are going to go down. Actually, last week, when we saw that there was a ceasefire, we saw energy prices go back down below $90. Although it had risen as high as over $100, $110 at one point. But we think that it's a short-lived outperformance. And so going forward, we want to be underweight to energy. We're also underweight to materials and real estate. So those are the sectors that we think we don't see a lot of opportunities going forward. And there are sectors that are not mentioned here. We want to be market weight at this point. And so although we try to get exposure to all 11 sectors in the S&P, the ones that we overweight to are where we see most opportunities. And the other ones will find the best, companies that we think we can get the most attractive performance from within the space. However, the overall uh, the overall markets we think are going to continue to do well. It's just going to be a matter of looking for the right companies within each of those sectors that we think we're going to, make our portfolios outperform going forward. So at this point, I'll pause and hand over back to Mildred as we take questions and for the Q&A session. Thank you once again for your time.
Okay, thank you, Albert, Eric, and Peter, for this insightful presentation. I believe we've received a wealth of information this morning, and which provides us with clarity. So to not waste more time, we'll dive into our Q&A session so that we can address any questions that you so have for us. Okay. So One participant is asking, I believe this question will be for Albert. What are the benefits and risk related to investing outside the country?
Wonderful. Thank you. Mildred, please, can you hear me?
Yes, I can.
Oh, wonderful. So yeah, so thanks for that question. I'll start with the risks and just following up on Peter's presentation. I believe the biggest risk for investors on the global markets, as you mentioned, emanates from the from the center of power in the US. Once our number 47 is in power, he would always shake up the world. But just on a more serious note, I think the risks that we our clients and I mean global investors are exposed to currency fluctuations, market volatility, so market movements based on uh, market operators' activities, and then your geopolitical developments, like what we saw in the Middle East, which continue to persist. Ukraine and Russia still persist, and so those are the risks that investors uh, eh, are exposed to or face by taking up opportunities in the global markets. But these risks are managed through appropriate diversification and asset selection. And so that's why you need that professional touch to ensure that, I mean, your exposure to them is mitigated or is minimized. For you to enjoy the benefits I'll touch on. And it's important to note that the risks that I've mentioned impact both local and offshore investors. You know, as the old saying goes, when the US sneezes, the rest of the world catches a cold. And so even if you hold your investments here in Ghana, you will still be exposed to these global market dynamics. So again, it's always important to get the professional guidance and professional support. But when it comes to the benefits, I think investing globally has numerous advantages. Firstly, I mean, it provides a currency hedge. So when your local currency is misbehaving like the city does on occasion, you are still able to preserve the value of your investments as held in hard currency, whether dollars, euros, or any of these global currencies. And it also reduces, or global investing also reduces your exposure to local market risk. Like again, we saw very recently in Ghana with the domestic debt exchange program, those market specific shocks do not affect your entire net worth or your entire portfolio of investments, right? And so that's a key thing to keep in mind. Additionally, the global market is deep and the opportunities abound. The investment options are a lot. If you take the New York Stock Exchange alone, I mean, it has over 2,000 listed companies, a mix of both domestic US businesses and foreign businesses that are all listed on the exchange. And so, investors who take advantage of that have a lot of opportunities that they can explore to build wealth, right? And so it's very important to take it. And then finally, Ghana Ghana, or at least, I mean, this part of the world, we are mostly net importers, right? And a lot of the things that we use, the laptops the headphones that we are using for this webinar are all imported and made elsewhere. And so investing globally allows us to enjoy the proceeds of that consumption. So not only are we enjoying the utility from the consumption, but we enjoy the proceeds of that consumption in the form of dividends or capital gains. I use Microsoft Office. If I hold a Microsoft share, all the fees and license fees I'm paying to Microsoft, a portion of that will come back to me when the company declares dividends. And so those are key benefits to keep in mind when looking to expose yourself to the global market or offshore investment opportunities. Mildred.
Thank you.
You're welcome.
Um, so the next question, I think it goes to Eric. What would you say to an investor who is currently sitting on the sidelines waiting for the right time to invest?
Thank you very much, Mildred, for that question. And the simple answer will be that I want to take it from two different perspectives. So let's say someone who is not actively investing and who just wants to get to the global market. So, I mean, the simple answer to the person would be yes, you are supposed to have started investing about 4 or 5 or 10 years ago. The next best time to invest is now. And also from the perspective of somebody who's already in the global market, who for one reason or the other feels that due to valuation concerns, he just needs to pack cash and, exit, the market. But then, for such a person, the simple answer will be that you can never time the market. Anyone who sold in March, right? And who was waiting for some bit of clarity and plan to get back once things have calmed down, missed one of the strongest quarters on record. So the S&P was up over 21% and emerging markets up over 24% in Q2, right after the West, right after we had all that debacle we saw in Q1 where markets, kind of went down. Now, but then this is not some story I'm picking out from a textbook. This is something that really happened just 6 weeks ago, right? So if the hesitation is about entering all at once, then I'll just recommend that you dollar cost average, you phase capital into the market over a few months, and that should solve the emotional problem. And it's a far better outcome than waiting on the sidelines through a rebound like what we just saw. So for me, the simple answer will be that the best time to invest is now, but then with some bit of guidance and help from a professional.
Thank you, Eric. And the next question, I believe, goes to Peter. What are the key indicators that the investor should monitor between now and the end of the year when assessing their portfolio?
Thank you, Mildred, for that question. So, the main factors to keep an eye on for an investor will be on the macro trends. So, looking at what inflation is doing, where it's trending, and how it affects our portfolios. We're looking at where interest rates are. That affects, the risk premium that will be associated with any form of investing. We also want to see where the job market is looking, how it's looking. So unemployment or employment levels. That also affects how consumers spend. And then how companies are doing in general. So companies that we're invested in, we want to see what the outlook looks for, the sectors in general and the companies and how they fare within, those spaces. So as far as, what factors to monitor, those are the main ones that I'll look at. And then I'll juxtapose that with the broader macro, factors like the geopolitical, risks that we will see to be going on and how they affect, some of the decision making on the global, level. So those are the main things that I'll keep an eye on as far as investments, go between now and end of the year. Thank you.
Thank you for that answer. So someone is asking, the Ghana stock market outperformed the S&P, but no investments locally. Why are we not supporting the local industry? I believe this goes to Peter.
So short answer to that is no, we do support our local industries, our local companies. The main, cracks for the Access Wealth Management is to help our clients diversify their portfolios. A lot of our clients are already very, very much invested in the global markets. Mind you, we are primarily a pension company. Our pension assets are invested in the local markets. Now, clients due to the previous, crisis that we face on our economies, And in our country, there's been a risk of, not being globally diversified, where we've had currency fluctuations affecting portfolios domestically in a negative way. We've also had, hyperinflation. So one thing or one uh, request that clients, were looking for was how do we manage our portfolios in a way that is not negatively impacted when there's any currency fluctuations or when there's any hyperinflation situation. And so, the wealth management part, we looking to diversify across the globe was a way to help mitigate the local market, risk. And so that's why the focus currently on the wealth management side is to, bring the global investing to the local investor. So we do still like our, local portfolios, but when our are able to invest globally, mind you, all the proceeds are coming to the local investor. And so they take dividends, they're able to spend it locally. However, the fact that it's a hard currency, when they convert it to local currency, it actually enhances the performance of their portfolios. And then majority of the clients will spend those proceeds, locally to boost the local economy. And so net, it benefits the broad Ghanaian economy. I hope that answers your question. Thank you.
Thank you. So a participant is asking, in recent times, we hear Standard Chartered intend to sell its retail banking, and I guess there's a lot of panic in the market of investors. What safe nets are in place to protect our funds should Axis leave the market? I believe Albert can answer this for us.
Yeah, sure. Sure, Mildred. And thanks for that question. A very, very important question. And let me start off that the concerns are legitimate, and we do not downplay them. However, there are differences in the in Axis's context versus that of Stanchart, and not to bastardize Standard Chartered in any way, but for just to start with, Axis is not going anywhere. Unlike Stanchart, we are a homegrown company. We are a native business, wholly owned. Ghanaian company, and so we have nowhere to go, and we will not be exiting the market. But that being said, if Axis decides to stop operating, right, then this question is certainly or this consideration is key. And another differentiator again between the service that we provide and that which Stanchart does is that unlike Stanchart, we do not lump all clients together. Again, each client is treated as a different or a separate entity on its own. If you open separate accounts with your wife, we don't treat you, or with your partner, we don't treat you as the same. We treat husband differently and the wife differently. And why do I say that? Every account that we open is opened in the client's name, and so we open it in your name, and you are the only one that can fund, and you're the only one that can withdraw from that account. And so in this case, it's essentially a separation of the custody of your assets and the management or the asset advisory in itself, which is done by Axis. And so one, the account is in your name. You have access to it through a portal and a mobile app. You can go in, you can check in what's happening. You can withdraw, you can fund as you please. And so where Access comes in is to manage the assets within the account, right? And so without Access, you still have full control over your account and over your funds. The second thing is that we, again, like I mentioned, we come in from the advisory front. From a custody perspective, we have a partner, or we are mandated to have a partner in the US that is also licensed and regulated by the SEC in that jurisdiction, or by the Securities and Exchange Commission in that jurisdiction, to then custody your assets. And so the partner we deal with knows each client individually and not Axis, right? Like I mentioned, the account is open in your name. And so if Axis is no longer in the picture, that account still remains with the custodian and you have access to it. If you want to move it to another broker dealer or another custodian in the US or wherever in the world, you are free to do that, move the assets. You are free again to withdraw the funds into your bank account whenever you please. So the control that our offering gives our clients is a layer of reassurance, or provides a layer of reassurance for our clients. And then of course, like I mentioned, the final thing is that you have insurance cover of up to 30.5. Again, because it is open in your account, in your name, every account holder is afforded that insurance cover on an individual basis. Unlike in the Stanchart case where it's a commingled account, or it's lumped together, each client that we have has that insurance cover of up to 30.5 million. And so there are layers of safeguards put in place to ensure that if Advent is no longer in the picture, your funds are safe. And with the cover, if your assets size or your portfolio size exceeds that limit, we can have conversations and increase your insurance cover for your portfolio. But all these layers are put in place to ensure that you are investing comfortably and you have peace of mind whilst you are trying to grow wealth on the global stage. Thank you.
Okay, thank you. So it's safe. Um, I'd like Eric to assist with this one. Someone is asking, how come the growth or return I see on my portfolio differs from the market performance? There's a follow-up question honest, where the person includes that honesty, the foreign investment. Okay, so Eric, you can go ahead and answer, and then I would add the follow-up question.
All right, thank you very much. And so, I mean, no two customers are the same, right? And or no two investors are the same. As we mentioned on this platform, the investment universe is very wide, and you have different categories of investors. Now, if you caught portions of Albert's presentation, he spoke about the fact that before entering into the market, there's a risk assessment that's done. So basically to assess your ability and capacity to take risk. And based on that, you are put on a particular portfolio. So most likely, if there's a question about performance, I would want to assume that the person would most likely be on the conservative side of things. And if you're conservative, most likely you'll be doing mostly fixed income, etc. And with global markets, fixed income do not really reward you that much because developed markets debt rates are normally around the 5 and the 6% thereabout. The joy mostly comes from equity. So we are very happy to look at this particular person and look into their portfolios and probably have a one-on-one session and possibly see how best to readjust. There's so many other portfolios that you have. So my biggest guess will be probably giving the person a bit of equity exposure to the level the person can tolerate, so that the person gets the kind of returns that they're looking out for.
Okay, thank you. So I believe the person would contact us after the webinar so we can have a one-on-one session to dive further into what was discussed. Okay, so I will move on to our questions. Please keep them coming. This next question goes to Peter. How are you positioning portfolios to take advantage of the opportunities you foresee?
Thank you, Mildred. So as far as looking forward, we've done a few changes to take advantage of what opportunities we see coming to the end of the year. And that included adding some utilities to our portfolios earlier on this year. due to the whole AI phenomenon and how much energy is needed, to power the data centers going forward. So we increase our allocation to energy, specifically nuclear energy. We've also increased our allocation to emerging markets because we see a lot of opportunities there with attractive valuations. Now, going forward, we'll be looking at valuations for some of the tech names that we like that are trading close to all-time highs. Um, but the areas that we continue to like I highlighted earlier on, we like industrials very much due to the industrialization and reshoring going on. We still do like, and then we like the whole the AI phenomenon, and so that and the one of the iterations of the whole AI trade is data centers, which sits within the industrial space. We like tech still, and then we still also do like utility. So those are the three main sectors that we like going for. We took a little bit of energy exposure, but that will be kind of wound down before towards the end of the year because it's not a long-term play. But we've increased our allocation to emerging markets. We've increased our allocation to the tech space. And then we also see opportunities. Uh, we also see opportunities and in commodities, and so we've also added some commodities to our portfolio, and that's primarily as a way to hedge against the geopolitical tensions and risks that we see coming out of the Trump administration. And so those are the some of the positions that we've taken to take advantage of what opportunities we see going forward. Thank you.
Thank you too. So, someone is asking, what investment strategies would you recommend for someone approaching retirement compared with a younger investor? I believe Albert can answer this for us.
Sure. Thank you, Mildred. I'll be a bit controversial here. I'll say the traditional answer to this is to match the duration of assets with liabilities or like liquidity needs, right? So essentially, for someone approaching retirement, usually the priority is capital preservation or managing downside risk with a higher allocation to more stable income generating assets. But however, I would say that the right strategy should always be based on the individual's goals and risk tolerance and their horizon in terms of when they would like to draw down on that investment and generally their unique circumstances. So, and the reason why I say this is because there are some retirees that have the capacity to pursue aggressive or growth strategies, even more so than myself, a young man, right? And so it's very important that the person's unique circumstances are taken into consideration, and that is why at Access Wealth, in offering this service, we take our time to understand the client's unique situation. It's very, very key, and so I I won't say there's the traditional approach which I've highlighted earlier, but I believe that for each retiree, we need to take it on a case by case basis, evaluate their situation, and then recommend the right strategy for them to achieve their financial goals.
Okay, thank you. Another question to you. Somebody wants to know how are the investments interest, sorry, accrued on the investment and how often can they make withdrawals?
Okay, very, very important question. So, I mean, it depends. So, it depends on the specific portfolio construction, right? Returns may come through capital appreciation or what we call capital gains, or through income. So, income into the portfolio, that is dividends or coupon payments. So, those are usually how your interest will come or your portfolio would grow, right? Or your capital will grow. That being said, in terms of withdrawals, I believe that the person wanted to know about withdrawals. In terms of withdrawals, they can be done at any time, like I mentioned. The account that we open for you is open in your name, so you're the only one who can fund it or withdraw money out of it into your bank account. across the globe, right? And so they can be done at any time. We only ask that we are given a heads up, or we are given ample time or ample notice, so that we do not sell when the market is down. If you don't have enough cash to meet the withdrawal that you are making, and the assets or your funds are held in the investment assets, we ask that we get enough notice to sell at the right time, and then let those funds settle in as cash for you, so that you can do the withdrawal. But again, for every client, our strategy is to balance their return objectives with their specific liquidity needs, right? And so once we know that there's an upcoming liquidity need, would ensure that we have enough funds sitting in cash in your portfolio to meet that withdrawal.
Sure, thank you so much. So someone is asking, how should investors approach the global equity markets given this level of volatility? I'll let Eric take this.
Thank you very much, Mildred, for that. I mean, volatility, I mean, for me, I'll say that, I mean, the global markets have always been volatile. Volatility is here to stay with us. And as far as what's happening recently is concerned, I would say that two things are true at once, right? We've seen that the AI-driven earning story is real, right? And still has room to run, right? And the market is more crowded now and more fragile than it was a year ago. And in fact, JP Morgan's own view sees that the S&P 500 is going to reach 7,800 by year end on the back of a 29% EPS growth. Also, there again, about 79% of strategists in a separate survey also believe that AI-driven volatility is also here to stay and is most likely that, and this is even the most interesting part, is most likely to spread across industries. So it's just not going to be concentrated around just the AI theme area. And even as most still expect large cap growth to also to keep leading the pack. So for me, I'll say that so far as volatility and valuation concerns are concerned, and in terms of how to approach equity markets, you don't have to fight the trend, but and also at the same time, don't let one theme dominate your portfolio. For instance, the Q1 to Q2 round trip we saw this year is a good lesson. A violent drawdown followed by a historic recovery in the same 6-month window. So, so far as equities are concerned, I'll say stay invested, be disciplined, keep your position sizes in the AI genset names very, very disciplined, and also use pullbacks. And because remember that as far as global markets are concerned, you're not going to see a straight line up. The moment you have pullbacks, you take advantage of them to rebalance into parts of the market that are slightly undervalued. So the theme really here is that you should just be disciplined. Don't be too greedy. Just because you've seen one part of your portfolio is doing so well, you're just going to pump everything in there. Just be disciplined and ensure that you're also taking advantage of the pullbacks that the market pullback opportunities the market gives that, so that to ensure that you have a winning formula to stay happy and stay invested on the global market.
Sure, thank you. So the key word is be disciplined. This next question goes to Peter. In the first half of 2026, what has surprised you from an economic and market perspective, and what lessons should investors take away from it?
That's a very loaded question, but thank you for that question. The biggest lesson, so far this year, is that you have to be ready for surprises, right? So nobody expected energy to be the best performing sector year to date. And so it's always good to keep that perspective that, there's always going to be some kind of unexpected shocks to the market. And obviously, this was driven by the war in Iran. But the biggest lesson from that experience is the importance of diversification, right? The saying goes that diversification is the only free lunch in investing. It's good to have exposure to across sectors. You may be overweight and underweight to areas that you like and do not like, respectively. But it's good to have some kind of exposure to almost every sector that you can think of. As long as there is an opportunity, in that sector, it's good to have some kind of exposure because you never know where the catalyst is going to come from. So we did not expect energy to outperform, but because we had some exposure to energy, that helped our portfolios. And so it's always good to be diversified across portfolios. And that's one of the lessons that we took from this experience so far this year. And we'll continue to build our portfolio. So one of the things that we try our best to do here at Access is that on the equities, at least on the equity side, we build our portfolios such that it will endure or it's likely to endure different market cycles. And so we do not like to just chase returns where we kind of put all of our eggs, one or two baskets. We try to have a balanced portfolio across sectors, all the 11 sectors of the S&P 500, as well as all the regions across the globe. So developed markets, US, developed international, and emerging markets. And so that helps when one area or one sector is underperforming, for a period of time, another sector is likely to pick up the slack. And so at every point in time, we do have some kind of, diversified portfolio that helps to weather some of the volatility. And so that lesson has been learned and it continues to be, play an important part of our investment philosophy going forward. Thank you.
Okay, thank you so much. Someone is asking, what one mistake do you believe investors should avoid making in the second half of the year? I'll let Mr. Corti answer this.
Thank you very much, Mildred. So it's quite similar to, the earlier response, but then I'll say that one mistake we should avoid going to the second half of the year will be, I'll just pick over concentration, right? So over concentration in whatever just worked for you. Now, specifically, staying purely invested in mega cap AI winners and treating the rest of the markets like some kind of afterthought. I mean, it's a natural instinct after a year like this one, but Q2 also was also the quarter where we saw small caps and also emerging markets caught up in some cases around the mega caps. So even strategists who remain structurally bullish on US large cap growth increasingly flag AI-driven volatility as some kind of risk that could spread across industries. Now, with that said, which is exactly the kind of environment where a concentrated portfolio gets hit the hardest. So for practically, the mistake you don't have to be, it's not about you being bullish. It's being bullish on one trade. So rebalancing back toward target weight after a run like Q2 rather than letting the winners compile into an unintentionally concentrated book. This is one of the most biggest mistakes you could make. Simple in plain English language. I mean, there's a reason why you have your target allocations, right? So for instance, you are expected to, so you keep an eye on your portfolio. And if there's one particular segment of your portfolio that is outperforming, you should keep it rebalanced. I mean, rebalance doesn't mean you are punishing yourself and denying yourself of return. So it feeds back into the fact that you still ought to be disciplined. Definitely, there will be portions of your portfolio that would be outperforming. So if you are not careful, unintentionally, your portfolio will become unbalanced just because you have one part of your of your strategy doing so well. So you keep your eye on that. Don't get carried away because that part of your fund is doing excessively well. So you just also let it go. You trim them and make sure that they are all within a respectable size. So over concentration is one thing that we need to watch out for because the market is extremely fragmented. Indeed, we've had just about 8 to 10 companies driving the whole entire S&P. So most likely, if just 8 companies are driving the whole S&P, you can imagine if you had one of those companies within your portfolio, most likely it's just going to get out of size, get out of range, the target range supposed to be. So be disciplined. When you see an extreme high fly, just keep it in check and just to make sure that you manage risk, manage volatility, and you keep things well balanced for your portfolio. Yeah.
Okay, thank you, Eric. We'll take our last question, and this will be answered by Albert, I believe. So, what level of support or contact can clients expect from your dedicated wealth advisors?
Thank you, Mildred. So as mentioned earlier, each client is assigned a dedicated wealth advisor. And so we encourage you to engage them as often as possible. But clients can expect ongoing um, relationships with their advisor, including, portfolio reviews when there's any question that comes up, market updates, investment guidance, and proactive communications on general developments, be it on the product or business side or on the market side. And then I want to add that the frequency of engagement is tailored to the client's needs, right? So the advisor is available. Is available as long as you need them, and please feel free to notify your advisor, and they'll make the time to support you, right? And these advisors, or these assigned advisors, or clients are not limited to just the assigned advisors, right? The entire wealth team is also available to assist when there's a need, or when your dedicated advisor is out of office and someone else needs to step in. And so that's also another layer of support that clients can expect. But I want to add that our quarterly review meetings with clients, those are structured engagements. Similarly, our annual webinars are also structured engagements, like the one that we are currently having, is structured. And other ad hoc engagements are structured to provide support and key information that will aid, clients in their decision-making processes. And so there's a wealth of support. We'll do our best to be proactive and reach out and ensure that that we are available, but would also appreciate the clients also, notifying us when they need the support, and we'll certainly make ourselves available to help. Thank you, Mildred.
Okay, thank you to Albert. So, all too soon, we've come to the end of this morning's session of our webinar. We thank you so much for joining us. We hope you found it very insightful and educative as well. So, we encourage you to contact your various advisors via um, the number on your screen at the moment. And when we are done with this webinar, a form will appear so that you can answer and before you exit the webinar. We are really grateful, and we want to thank our panelists, our speakers as well, for the time and effort they took to have this webinar done and the preparations they did. We are really grateful. Kindly leave your contact details, and any of our advisors would contact you to discuss your specific needs. Once again, I say thank you for joining us, and we wish you the best of the day. Thank you.
Thank you.
Thank you.
Every successful journey begins with direction. At Access Wealth Management, we are the compass for your financial future, helping leaders, executives, and legacy builders plan, grow, and preserve their wealth with confidence. Through expert financial planning, tailored investment strategies, and offshore investment opportunities, we give your money the direction and structure it needs to work harder and last longer. Our bespoke investment solutions are crafted with precision and built around your unique financial goals. Backed by deep market insight and a client-first approach, we help protect what you have built while positioning you for future growth. Because real wealth is not built just for today, it is about building a legacy for tomorrow. Speak to our wealth advisors on 02630-15323 to learn more. Access Wealth is licensed and regulated by the Securities and Exchange Commission. Access Wealth Management, your trusted partner in building sustainable wealth.